Warren Buffett just retired with $382 billion in cash. That's more than the Federal Reserve holds in Treasury bills. For 12 consecutive quarters, he's been a net seller of stocks. He sold 67% of Apple. He's still selling Bank of America. Meanwhile, his own Buffett Indicator, the metric he once called the best single measure of where valuations stand, just hit its second highest reading in 155 years. The only time it was higher was right before the dot-com crash. But here's the part nobody's talking about. He's not just sitting on cash, he's earning $13.5 billion a year in risk-free interest while he waits. Waits for what? That's exactly what we need to talk about today, because when you see the pattern, and I mean the full historical pattern of what happens every single time Warren Buffett hoards cash at valuation extremes, you'll understand why his actions might be the most important signal in the market right now. I'm Max, and this is Max Invests. We break down how the smartest investors think and act. If this is your first time here, hit subscribe and drop a comment. Are you fully invested, or are you raising cash like Buffett? Let's get into it. Most people hear that Buffett is holding all this cash and they just shrug. He's 95. He just retired. Maybe he's winding down. Maybe he can't find deals at Berkshire's scale anymore. Or maybe the Oracle has simply lost his touch. That dismissal is the trap. It lets you ignore the single most important capital allocator on the planet. It's exactly what people said back in 1999 when he refused to buy dot-com stocks. They said he was washed up, behind the times. Fortune magazine practically wrote his obituary as a relevant investor. Then the market crashed 50% over 2 years. And Buffett? He was buying assets for pennies with a pile of cash he'd been building for years. 1999 wasn't the first time. In 1968, he closed his entire investment partnership. He gave the money back to his investors. He said he couldn't find value anywhere. The market then crashed over 30% by 1974. Again, in 2005, he built a massive cash position years before the housing crisis. When the system melted down in 2008, he had cash to cut deals with Goldman Sachs and GE on terms so favorable they were practically highway robbery. So when Warren Buffett hoards cash at valuation extremes, it's not new behavior. It's a pattern. And every single time this pattern has appeared, a significant market event has followed. That's not a coincidence. That's history. And that's why what he's doing right now matters for every investor. So let's break down exactly what he's doing now. I'll walk you through 5 layers. Layer 1 is the cash pile. According to Berkshire's third quarter 2025 earnings, the company holds $381.7 billion in cash and treasury bills. That's up from $344 billion the prior quarter. The cash is still growing. Cash now represents 31% of Berkshire's total assets. That's the highest percentage in over 30 years. $320.5 billion of that is in short-term U.S. Treasury bills. That single number exceeds the Federal Reserve's own Treasury bill holdings, which are around $195 billion. A private company holds more T-bills than the central bank. Let that sink in. No one else in corporate America has ever sat on this much risk-free cash. That's not caution. That's conviction. Layer 2 is the selling spree. Berkshire has been a net seller of stocks for 12 consecutive quarters, 3 full years of selling more than buying. Total net sales since the first quarter of 2022 exceed $183 billion. That's the largest selling spree in the company's history. And get this, 0 share buybacks for 5 consecutive quarters. Buffett used to love buying back Berkshire stock. It was the easiest way to create value for shareholders. But with Berkshire's price to book above its 20-year average, he doesn't even see his own stock as a bargain. The man who built the company and knows its value better than anyone will not buy his own shares at these prices. And the reason goes deeper than most people realize. It's not just that the market is expensive, it's which names he's choosing to exit. Which brings us to layer 3, the Apple and Bank of America exits. Let's start with Apple. In January 2024, Berkshire held 95.6 million shares. That was about 50% of the equity portfolio. Then quarter by quarter, he sold. Over 116 million in the first quarter, 389 million in the second quarter, another 100 million in the third. When the dust settled, he had sold over 600 million shares. He reduced the position by 67%. Apple is still the largest holding, around $65 to $70 billion, about 21% of the portfolio. But the scale of that reduction is staggering. Why sell Apple? He's praised Tim Cook. He's called it one of the best businesses he's ever seen, because Apple's price to earnings climbed above 30. At his core, Buffett is a value investor. He doesn't care how great the company is if the price doesn't make mathematical sense. He's criticizing the price, not Apple. Now Bank of America. Buffett saved Buffett in 2011 with a $5 billion investment during the crisis. He made tens of billions in profit from it. Starting in July 2024, he began systematically reducing his stake. In the fourth quarter of 2024 alone, he sold 117.5 million shares. His ownership dropped from over 13% to 8.9%. The bank trades at 1.8 times tangible book value. That's well above its 10-year average of 1.5. Expensive by Buffett's standards. So he's selling. Same logic as Apple. Great business, wrong price. He's not emotional about it. He's just following the math. Layer 4 is where it gets really uncomfortable. The valuation nightmare. The Buffett Indicator is total stock market cap divided by GDP. It just hit 220%. Some data from Guru Focus put it at a record 222.7% in January 2026. The historical average is around 80%. Before the dot-com peak in 2000, it was 140. Before the financial crisis in 2007, it was around 110. Now we're at 220 plus. It's not just above his overvalued threshold of 120. It's nearly double. Then there's the Shiller-Cape ratio. That's from Nobel laureate Robert Shiller at Yale. It compares S&P 500 prices to inflation-adjusted 10-year earnings. The historical mean is 17.3. Right now it's above 40. The only time it was higher was the dot-com bubble peak at 44.19. When CAPE is this elevated, Shiller's data implies about 1.7% annual return over the next 8 years or so, versus a historical average of over 10%. The math says stocks from these levels may return almost nothing for the better part of a decade. That doesn't mean a crash is guaranteed tomorrow. It means the odds of strong returns from here are historically low. Now, some of you might say, this time is different. AI is real. These companies actually generate enormous cash flows. Apple, Alphabet, Microsoft. This isn't 1999 speculative mania. I get it. And those companies are nothing like the junk from 99. But valuation still matters. Even a great company can be a bad investment if you overpay. Think about Cisco in 2000. Phenomenal business. But if you bought at the peak, you waited over 20 years just to break even. Business quality doesn't protect you from overpaying. There's another risk: market concentration. The top 10 stocks dominate the index in a way we've rarely seen. If you're in a passive index fund, you think you're diversified, but you're actually making a massive concentrated bet on a handful of names. If those correct, the whole market corrects. So your index fund isn't as safe as you think. If you're finding this useful, hit subscribe and tell me in the comments. Are you raising BE or are you still bullish? I read everyone. Layer 5 is the tax angle. The current corporate tax rate is 21%. There's real discussion about rates potentially rising. Some proposals suggest 35%. If Buffett realizes capital gains now at 21% versus waiting and potentially paying 35% later, the math is enormous. On hundreds of billions in gains, tax savings could be tens of billions of dollars. So part of the selling spree isn't just valuation. It's locking in a lower tax rate while it still exists. On that scale, we're talking about tens of billions saved. That's not panic. That's chess. Here's the real magic. It's not any single data point. It's the psychology behind the behavior. Buffett doesn't need to predict a crash or time anything. He's built a position where he wins regardless. If markets keep rising, he earns 3.7 to 4.3% on treasury bills. Risk-free. That's $13.5 billion a year for doing nothing. If markets crash, he has $382 billion in dry powder to deploy. At current prices, that could theoretically acquire over 480 S&P 500 companies. Downside is modest. Upside is generational. He doesn't have to be right about when or how. He just has to be ready. I know this isn't what a lot of people want to hear. Everyone wants to believe everything's fine. The market will keep going up. But understanding this doesn't mean panic. It means think. Now, what does Buffett actually say in public? He says Berkshire will forever deploy the majority in equities. The cash pile shouldn't alarm investors. He simply can't find attractive opportunities at scale. Calm, reassuring words. But look at his actions. Selling stocks for 12 straight quarters. Hoarding record cash. 0 buybacks. Reducing even his favorite long-term holdings. Words say, stay calm. Actions say, I'm cashing out. And when the two conflict, the actions are more what you should believe. His track record in 1968, 1999, and 2005 says, trust the actions. So what does this mean for you? You don't have Buffett's resources, but you can follow his logic. You don't have to copy him, just ask the same questions. First, review your exposure to overvalued sectors. Second, ask whether your portfolio is more concentrated than you realize. A lot of people think they're diversified with an index. They're not. Third, look at what T-bills and money market funds pay now. 4% plus risk-free is real money. That's not nothing when stocks might return almost nothing for years. Fourth, ask whether chasing returns at valuation extremes makes mathematical sense when Shiller Cape implies about 1.7% annual returns for the next 8 years. And fifth, you don't have to go to cash. But having dry powder and the ability to act when opportunities emerge isn't bearish. It's strategic. That's what Buffett has done at every major turning point. And while it's worth paying attention to, Buffett doesn't predict the storm. He builds the ark before the clouds appear. He didn't cash out to run away. He cashed out to reload. He's sitting on the largest war chest in corporate history, earning billions in interest every single year, waiting with the patience of someone who's done this 3 times before and been right every time. You don't need to predict what happens next. You need to be ready. The smartest investor who ever lived is telling you through every action that being ready matters more than being right. You don't have to sell everything, you just have to have a plan. Your future self, 5 to 10 years from now, is counting on you to pay attention. Not to panic, not to try to time the market, but to think clearly when everyone else is chasing momentum. Drop a comment below. What's your read on the market? Are you raising cash or are you still bullish? And if you have ideas for the next video, like Buffett's successor Greg Abel, or Treasury Dynamics, or AI valuation, put them in the comments. I read them all. Hit subscribe and turn on notifications for Max Invests. Thanks for watching. See you in the next one.